afternoon, everybody. If you're just joining us, welcome. We're going to give some people about 30 more seconds before we formally get started, but we're so happy that you're here with us. Hopefully, you take a minute, make sure your audio is all working, you can hear us, and we'll get started probably in about 30 seconds. All right, let's get started. I'm sure we'll have some stragglers that come in the room, but hi everybody and welcome. I'm Brian Hartman of Granite Bridge Wealth Management. Thank you so much for joining us today. We're super excited to have you here for what we believe is going to be a really informative session and more timely conversation geared around alternative investments. This is a topic that's becoming increasingly relevant for many of our clients who have had lots of questions for us. We credit that a little bit to there being a lot of news articles, financial publications. If you tune into Yahoo Finance or any other online forum, you're probably hearing information about alternative investments. And so we wanted to use our time today to shed some light on exactly what they are and how they work inside of your portfolio. So whether you are looking to diversify for your portfolio, hedge against inflation, or simply understand the role that alternatives may play in your broader financial plan, this session is designed to give you practical and clear insights on what that all looks like. We are luckily joined today by two familiar faces from our advisory team, Dalton Heffel and Jay Roush, who are going to walk us through the rest of today's presentation. I just want to take a minute and say thank you again, whether you're joining us live or a recorded version of this. This is our eighth webinar of 2025, all part of our effort to make our clients the most educated, confident, and comfortable in the marketplace. So with that, I'm going to pass it over to Jason and Dalton. And once again, thank you so much for being here with us today.
All right. Hey, everyone. Thank you, Brian, for that warm introduction. I'm excited to be here. And I'll kick off the conversation with the question you might be asking yourself to start. What are alternative investments? We're considering anything that's not your traditional asset classes as alternative investments. And your traditional asset classes are, your stocks, bonds, cash, things that make up a majority of most people's portfolios. And we've got some examples listed here. This isn't necessarily an exhaustive list, but, a list that we wanted to walk through and have some discussions about. And the first we've got here is real estate. And real estate can come in the form of both private investment and public investment. And in public, some of you may already invest in real estate through what we call REITs, real estate investment trusts. And those are publicly traded securities that give you exposure to the real estate industry and sector. But there are also private investments that can have different risk and return profiles than those that are publicly traded. So that's an interesting category of private investments as well in the real estate sector. Then we have hedge funds. And hedge funds, most people kind of cringe when they hear hedge funds. They think that they are, high risk, high return, swinging for grand slams all the time. And some hedge funds do that, but not all hedge funds do. They don't all have the same objectives. Some hedge funds have strategies that are lower risk and have different risk return profiles. So there's quite a few number of hedge funds out there that can be explored that might be right for you and your portfolio. Then we get into private equity, private credit, venture capital. These are generally early stage young companies that are still privately held, right? They're not traded on public exchanges. They're not necessarily easily accessible. They're not necessarily profitable companies, but they're private, they're young, they offer the opportunity for generally higher risk, higher return type investments. And we'll see a chart that sort of graphs our risk return profiles on certain investments and where they fall shortly here. Next category, we have real assets. And within that category, we have things like commodities, infrastructure projects, collectibles. Collectibles can range from anything from fine art to fine wines, cars, watches. And this category we tend to think of as inflation hedge opportunities. Next, we have liquid alternatives. And liquid alternatives also come in all different shapes and sizes. But as the name sort of says, they are amongst the most liquid alternatives available. Generally some of them can be traded in a day, get your money in and out with daily liquidity, just like you might trade a mutual fund or an exchange traded fund. But they do come in different shapes and sizes and colors that we can explore to see if they fit your risk profile in your portfolio. And within the liquid alternatives, we have digital assets, cryptocurrencies, Bitcoin, Ethereum, things like that we would put into the liquid alternative category, especially with the recent launch of the exchange traded products for Bitcoin and Ethereum, which have gathered assets at historic rates. They've really grown in size very, very quickly. They've set a number of records and how fast they've grown and how much assets they've gathered, because there is so much interest from both retail investors and institutional investors. So, that's an area we have our eyes on as well. And when we take a look at the next slide, we'll see this chart. I sort of alluded to it earlier. It's just a cool little chart that shows the range of risk return profile of different alternative investments, and sort of call it maybe the complexity scale. And as we look at the lower left, we see things like short-term strategies and liquid alternatives and mutual funds that are on the lower end of your risk return profile. They tend to be a little less complex than some alternatives, and they generally tend to have good liquidity if you want to get your money in and out. And as you move up and to the right on this chart, we see that the risk return profile gets higher, so you'll be susceptible to higher risks, but potentially higher returns. And if we look at private equity all the way at the upper right, fits into that category of amongst the highest risk, highest return opportunities in the alternative space. And with that comes a little more complexity, and a little less liquidity. So just a cool, interesting chart here to show you the scale, what we'll call the complexity scale. All right, now that we've talked a little bit about what alternatives are, I'm going to send it over to Dalton to talk a little bit about why we're looking at alternatives and why you may want to consider it for your portfolio.
Great. Thank you, Jay. So now that we know kind of what alternatives are, let's get into the why and why you should consider it as part of your overall portfolio. So first off, they can offer diversification and uncorrelated risks and returns versus stocks and bonds. So alternatives help spread out your investments across different types of assets. So if stocks and bonds are struggling, alternatives may still perform well. A great example is in 2022. That was a down year pretty much across the board for stocks and bonds, but some alternatives were a lot less negative, or they even had positive returns for the year. The second is they can act as an inflation hedge. Some alternatives tend to keep their value or even grow when prices rise. So real estate alternatives are a great example, or even commodity alternatives. And then some alternatives, such as private equity, can potentially offer the chance for higher returns. So especially in areas where traditional investments may be limited or slowing down a bit. And then they can give you access to unique opportunities. So alternatives really open the door to investments that aren't always available in public markets. So a few examples would be private companies, hedge funds, or infrastructure projects. And it's also important to note, for the first time ever, they're likely going to allow these alternative investments into 401k plans. An executive order was just signed last week putting this all into motion. So it's not going to happen right away. It's going to take some time to implement, but we will be keeping a close eye on that. So on the next slide, you'll see a chart. This chart shows the correlation of stocks and bonds going all the way back to 1992. So what correlation is, it tells us how closely bonds are moving in relation to stocks. So the higher the correlation, the more bonds move in the same direction to stocks. So ideally, we want to see a low or negative correlation for the bonds to be a good diversifier. And historically, on average, you can see there in the chart, bonds were a pretty good diversifier, especially from 2000 all the way to 2020. You can see that they had that low or even negative correlation. But then more recently, the bonds have a high correlation. You can see on the right there in the red of about 0.72, which is pretty high. So it basically means that you're not getting that benefit that you once were from bonds in your portfolio. So many alternatives can offer that low or negative correlation to stocks. And on the next slide, you'll see another chart here. So these two charts show the upside and downside capture ratios of a 60-40 portfolio compared to the S&P 500. So meaning 60% stocks and 40% bonds in the overall portfolio. So the upside and downside capture ratio basically tells us how much of the 60-40 portfolio gains in good markets and how much it's losing in bad markets when compared to the S&P 500. So as a quick example, if the S&P is up 10% in a given year, if you look at the yellow and red bars on the left there, the 60-40 portfolio would be up 6.6%. And then contrarily, if the S&P was down 10% in a year, that portfolio would be down 5.7%. So historically speaking, bonds were a great diversifier. But then if you look at the bars on the right there, you're pretty much getting the same return to the upside, 1% higher. But then to the downside, you're capturing a lot more of it, about 7.4% to the downside. And then you can see on the chart on the right there, for the first time ever, the red crossed over the yellow. So again, it's telling the same story that you're capturing more of the downside within the same portfolio. And then on the next slide, you'll see a few more charts here. I know there's a lot going on here, but the main point is that companies are staying private for a lot longer. And when these companies finally do become public and publicly traded on the market, their value is a lot higher than it used to be. And so alternatives can allow us to invest in these companies that are choosing to stay private for a lot longer. And you can potentially participate in their growth. So I'll kick it back to Jay real quick, and he's going to go through a few more fun charts for you guys.
All right, thanks, Dalton. I do love me some charts, and thank you all for hanging in there with them. I know there's a lot of lines and squigglies and colors and bar charts, but hopefully we're doing a good job sort of digesting the material here for you. And this chart's one of them that can look overwhelming, so I'll try to simplify it here, and we're going to focus on the chart on the right-hand side. And this is basically, JP Morgan's using a metric called earnings coupon yield to forecast the next 10-year annualized returns of a 60-40 portfolio. Again, 60% equities, 40% bonds. We'll be referencing 60-40 a lot in this presentation. And they've come up with this, regression analysis, and there's a few simple inputs into this analysis. It's the S&P 500 price and the earnings of those companies in the S&P 500, as well as the Bloomberg US Ag Bond Index and the yield of the bonds in those index. And when JP Morgan puts those together, we land on this red square. It's kind of turned sideways like a diamond if you see it on that right chart. And it says the implied return for the next 10 years of the 60/40 portfolio using this earnings coupon yield metric is 5.7%. And we see obviously that it's at the very lower left end of this regression line analysis, which is, 5.7%. It's an okay return, but it's certainly less than history. And, preferably we'd be somewhere more in the middle to the upper right of this chart. So, that's obviously a function of, markets, S&P 500 being at all-time highs. So when we see something like this, we ask ourselves, what can we be doing with our client portfolios to maybe improve the risk return profile of a 60/40 portfolio, kind of knowing that the implied returns using this metric and others is really not that great. So we think about alternatives, and that's why we're here today sharing this information with you all. On the next slide, we see what can happen to a portfolio when you add alternative investments to it. So if we just focus on the two pie charts on the bottom left here as a starting point, this graph shows annualized volatility or risk along the x-axis and annualized returns along the y-axis. And if we look at that 60/40, it's actually 60% bonds on the second from the left. It's 60% bonds, 40% equities. If we add 20% alternatives, like JP Morgan did in this analysis, it moves your portfolio up and to the left on this chart. And by moving up, it increases your projected annualized returns. And by moving to the left, it reduces your projected annualized volatility of your portfolio or risk. And anytime you can have your portfolio move up and to the left, that's the holy grail of investing. You want to take as least risk as possible to get as much return as possible. And that's what happened, is being shown here in this analysis. And that's why, we're thinking about what alternatives we can add to our client portfolios to improve the risk return profiles as well. And all right, on to our last chart here, everyone, and enjoy it. I will take you through it slowly. So this is showing the correlations, returns, and yields of different alternative investments relative to our 60/40 portfolio. Again, 60% bonds, 60% equities, 40% bonds. And we see that portfolio is all the way to the right. And as we move to the left, you'll see on the x-axis that the correlation to this 60/40 portfolio is getting lower and lower, and in some cases negative when you get all the way to the left, like the transports category and the US core real estate are negatively correlated to the 60/40 portfolio. And then you see things where there's yield opportunity, right? We see the big purple circle that stands out, and that's direct lending, right? So the bigger the circle means the more yield opportunity. Direct lending is kind of cutting out banks as the middlemen, where you may have the opportunity to lend directly to a borrower, and there's a number of companies that facilitate that out there. So that's lower correlated, less correlated to the 60/40 portfolio, and offers some yield opportunity. So just an interesting, cool snapshot here showing you the different alternative investments. So that's it for the charts. I'm going to kick it back to Dalton to tell us a little bit of what the trade-offs are in investing in alternatives.
Well, thank you for the charts, Jay. So alternatives have a few unique trade-offs that are important to understand before you invest in them, because they're a little bit different than stocks and bonds. So the first is complexity. So alternatives can be a little difficult to understand. And this is really due to the range of asset classes that they cover, their fee structure, and liquidity. But just know that your team here at Granite Bridge, we're here to help you navigate through all of it. And then liquidity. So how easily can you access your money? And the answer is for alternatives, it really depends. So some alternatives are liquid right away, and others have what are called lockup periods. And lockup periods mean you can't access your money for months or years at a time. So you should definitely know if your alternatives have any lockup periods before putting your money into them. And then risks and returns, right? Nothing, nothing is guaranteed. There is risk with any investment, but I would say the most important thing is to make sure you are investing with a reputable company that is transparent with what they're investing in. So we here at Granite Bridge, we do an in-depth due diligence on every company before recommending any alternatives to any clients. And then lastly, our fees. So the fees can look a little different. They can be a little higher. Some alternatives may have performance fees and also management fees. But even though the fees are slightly higher, it can be worth it. We believe if the alternatives are making your portfolio overall less volatile and giving you more return, the higher fees would be worth it. I'm going to kick it back to Jay real quick. He's going to go over some common questions that we get about alternatives.
All right, thanks, Dalton. We are approaching the finish line in sight here. So some questions that we get: how much should I allocate to alternatives? Obviously that's a very specific question that'll have a different answer for each client, right? Depending on your objectives and your risk profile. It also depends on which alternative investments you're investing in. If you're investing in some that have higher risk, higher return opportunities, you'll probably make a smaller allocation. If you're looking for something that is on the lower end of the risk return profile, where there'll be less volatility in that alternative, maybe you can make a slightly higher allocation. And then, we would have to see how it impacts your total portfolio construction. So kind of a nuanced question and a nuanced answer. What happens if I need to access my funds? Dalton talked a little bit about lockup periods and liquidity constraints. There are alternatives where you may not be able to access your funds for certain periods of time. So you definitely want to work with your advisor here at Granite Bridge Wealth to make sure that we fully understand those constraints together. Are these guaranteed to outperform? Are alternatives guaranteed to outperform? No. I wish they were. If nothing's a guarantee, if anything was, I may not be here with you all right now. But there's risk involved with any investments. So you got to take that into consideration, and certainly no guarantees in the alternative space. Can I lose all of my money in alternative investments? Theoretically, yes, right? Theoretically, you could lose all your money in any investments, in Apple stock, in an Nvidia bond. It doesn't necessarily seem highly probable that you would lose all your money in those types of investments, but it's possible. It's kind of the you never know kind of thing. And again, the volatility of your portfolio, how much money you can expect to lose, will depend on which alternatives you're investing in. But as with any investment, you should generally be prepared to lose all of your money, even if it's not a highly probable outcome. So how do I access these alternative investments? Well, we at Granite Bridge, we're proud to be a part of one of the largest broker dealers here in the country. And with their size and scale comes the availability of different platforms to us to invest across this spectrum of alternatives that we've talked about today. So if you have any questions about what you've heard or seen, we'd be happy to discuss them. And that's it for me. My last slide. I'm going to kick it back to Dalton for the final farewell. But thank you all for tuning in, and for anyone watching later. This has been a lot of fun, and we'll talk to you soon.
Thanks, Jay. Well, just real quick to wrap up, if you have any questions about anything that we covered today, please reach out to your team here at Granite Bridge Wealth Management. We're happy to help. And with markets being near all-time highs, it's a great time to schedule a portfolio review and to see if alternatives might be a good fit for you and your goals. So we're here to help you make sense of all the options that are out there. We know there's a lot out there, but we're here to guide you every step of the way so that it's not overwhelming for you. So I hope you all learned something today, and thank you so much for your time.